Hello, friends. Let's start for this topic called as factoring and forfeiting. So, you see, as far as this topic is concerned, this is mainly in context of a business entity who is selling goods on credit to their clients. So, you see, in business, majority of your transactions are done on credit. So, credit sale is an essential part. And when a businessman is doing credit sale, recovery of dues is actually a major issue. So you see, businessmen cannot leave his business for recovery. So they needs a specialized service for which again you see banks and other financial institutions may venture and then explore opportunities. This will help uh, these agencies to earn commission, or sometimes it is in the remuneration is paid in the form of fixed salaries. So you see, hence let's go into this topic and venture more on to this topic of factoring and forfeiting. So, what are the various areas which you will have a go through during this topic? Is like what type of risk is associated with credit sales? Who will protect the seller? Means the person who is selling it. So, lots of default related risks are associated to this person, which in other words is also called as bad debt. So, do we have any protection against bad debts? Then next is like seller sell his debts, or like you see your debtors or your clientele base to whom goods have been sold on credit, they're going to pay you on future. So is it possible, can we sell these bills receivable to someone? This is again one point in discussion. And finally, we are going to see the mechanism of buying others debt, whether it works or not practically in industry. Let's go into the discussion. So when you go through this topic, you'll come across these points. You'll come under and understand the risk associated to credit sales. Then you'll understand the context of a specialized service, which is like they're willing to take risk, and they would like to do financing of your debtors. And then finally, we will discuss something on risk management mechanism. So you see, this is the entire process, and every stage is mentioned with a particular number. So it will start with a credit sale. Sale of good is essential. A selling firm is there who is selling it. So they are manufacturing a product and then finally selling it to client. Let's say Coke and Pepsi, they are being these cold drinks are being bottled in certain plants, and when these cold drinks are supposed to be sold to vendors, through which you see ultimately the ultimate consumer is going to buy it. See, producing it in a factory and then sending it to like vendors, retailers, retail shops is what is the challenge. So here you see, even though these big brands, they give credit period of 60 days or 90 days depending on your market condition, like competition, what sort of price war is going on in your market. So these factors define your credit terms. Okay, now once you do this credit transaction, then you see you will have an invoice. Invoice is a bill which is being generated when you do some sale. Now you see, this concept of factoring is nothing but it is your debtor management. In other words, whatever invoices you have generated during these credit sales, they will be taken care by a specialized body. This body is known for their efficient recovery and smooth licensing with your debtors. So what they do is like, not only this, when you generate invoice, the next stage is like where there may be a possibility where selling firm may require some advance amount. Okay, so they may require it for some other purpose, some of their other emergency requirements. So you see, factor may have this provision also where they can give some advance upfront, and maybe on maturity date when it is due, any the date when your debtor is supposed to make a payment. So these factors will collect the money and will remit it to selling firm. Okay, so with this, you see these are 4 or 5 points which is there between selling firm and factor. And when it comes to factor and your data, you see data people, most of the time they are aware who is the factor, who is the collecting agent. So because selling company has already mentioned it, that ABC firm, let's say assume it that ABC firm is a factor here. So selling company will inform it to their clients that you see ABC firm will be doing the collection follow up with the entire clientele base. So there is no need to worry. Okay, so they will be coming in, will be doing normal conversation, sending normal notices, and when normal notices don't work, they'll send legal notices, or whatever may be the course of action they'll be taking, everything on behalf of selling firms. Sometimes this disclosure is not there, and customers, they don't know about the factor. Okay, so it is undisclosed factoring. So you'll see one type of factoring where it is not informed, but still they'll do the entire communication. So now factoring basics, you see regular flow of working capital. It helps companies to raise money without getting stuck into a situation. Usually purchasers, yani buyers or debtors, they delay the payments due to their own reasons. So what is required is like effective follow up is very important. Okay, so this is again important. Then expediting the collection process. If you need to fasten up your collections of your bill receivable, you see this is a very big challenge for a businessman. So for this you need a specialized body, a separate entity, a group of experts who will be doing it so effectively that the other party is not able to understand, and they are making regular payments on due dates without much of effort. Okay, so therefore factoring is a financial service which is specially designed to arrange payments of receivable in a better manner. So you see, this is a type of outsourcing that you are doing as a core business. You cannot focus on recovery part, so you can outsource it to this agency called as Factor. Okay, the concept is actually derived from a Latin word, where it means to make or to do or get it done from someone else. Okay, management is also an art of getting things done through others. So here, factor is the person who is supposed to do it on behalf of the businessman. So according to International Institute for Unification of Private Laws, UNIDROIT. This is in somewhere in Rome. So they have defined factoring as an arrangement between a factor, and that includes at least two services uh, to be provided. One is finance. Any you need money, they'll help you in it. Second is maintenance of accounts. So they'll manage your debtors, and then you have next is like you collect dues on due date. And finally, it is actually acting as a protection against the default risk. So this entire package is what integrates receivable management and is defined as factoring. Now you see this word when it comes to India, RBI is your apex body in banking sector. So if banks are supposed to act as a factor, as a recovery assistant to some of the business units, you see in 1990 they came up with the statutory framework. You see, without a framework, without a law, you cannot function. So there will be lots of legal complications. So in order to remove it, they came up with something in July 2019, 1990, and almost you see 3 decades and more. So they brought in this thing to make sure the banks, when they are going into factoring, their structure is clear, their policy is clear, they know how to operate. There are clear policy guidelines so that who is doing it and against whom it has to be done. They all are clear that there is a framework in place and we need to work according to the same framework. This brings in uniformity, this brings in standardization. Okay, banks are permitted to set up subsidiaries, any separate bodies. Bank will not be doing it, but there is a separate arm of a bank which will be like constituted specially for this task of factoring. Okay, so with the other bank in prior approval of bank, you see what is happening is like maybe they can do it collectively. Any one bank is not doing it. There may be two, three banks which will come up together, will contribute for the capital, but this will not be a bank. It will be a separate subsidiary, and then accordingly things will be done. They are allowed to form factoring department. And every bank can have one department which can be called as a recovery division. Okay, like for a normal NPA, they do have recovery team. Similarly, they can use the same recovery team. If you don't have an NPA in bank, you can use it for some external services also. Again, it is a sort of commission based business. If you help someone recover their dues with your legal team, you see your legal team is earning, helping your bank to earn some commission. And this, they have put up a restriction when you are doing it as a factoring team and you are investing in factoring subsidiaries also. So there is a check, you cannot exceed more than 10% of your total capital. Okay, so investment in a subsidiary is not supposed to be exceeded beyond 10% mark. Now in this picture you'll understand the entire modus operandi of a factoring process. So there is a client, there is a seller. Client means here client is actually client and seller mentioned same because you see for a factor client is seller. Okay, buyer is another party from where recovery is to be done. So seller is going to sell it to buyer, a credit transaction. So buyer is actually going to acknowledge yes they have received the goods. So when this acknowledgement is done, now this customer is no more a customer, he is a debtor. Okay, this debtor will be paying something in advance and maybe rest of the amount in installments, maybe lump sum on a future date. Whatever is your repayment model, you see factor will be informed on the same, and then factor is going to facilitate this transaction by giving reminders, doing follow-ups, doing effective communication, timely effective communication, because this is not a job of a seller, so they'll not be able to do it. So you have to do it timely, on timely interval, and you need to make sure that 100% of your investment which is there blocked in this data should be recovered. Okay, so ultimately, who is going to do it? Factor, as a commission agent, is supposed to do it on behalf of seller and will be able to recover it from buyer. Okay, so the entire process has been shown to you in the previous chart. So let's jump from this slide to the next slide. Here, only one thing: maximum period allowed is 150 days, and again, grace days. Let's say you default, and there is a discussion on negotiation is on. So we do have a provision that we may give you some extension, and this extension can be maximum up to 60 days. Okay. Now you see, commission rates are fixed. They vary from person to person. They vary from client to client. They depend on the risk factors associated to a particular client and their past track record. Okay. So this is what about factoring. Now factoring refers to account receivable by client to a factor who is actually a bank. So it unlocks firms cash that get tied up in receivables. So blocked asset is given some liquidity. So okay, so factors will come in and will try to bring in liquidity. If you need money in an emergency, they'll help you in it. This factoring can be of recourse or without recourse. Recourse means, if it is recourse means, let's say you are a seller, you sold some goods to buyer. Now you are in a state of emergency, you need some money. So if it is a recourse factoring, then you can take some money from factor. Okay, so factor will give you this amount, but there is a provision. Like on maturity date, if factor is not able to recover it from the other party, any from buyer, so in that case, seller will be returning it back to factor. Okay, so onus of recovery lies with the seller in recourse factoring, but most of the time you'll find there is like non-recourse factoring which is preferred, because there is an element of risk. So factor is going to take it 100%, and if there is a default, then factor is going to bear it. Okay, so let's go forward. So recourse factoring is what we just discussed. Like client, if they have taken some money, so from the factor, in anticipation that this money will be collected by factor on a future date. So you see, if factor is not receiving it, then seller has to bear the loss and he has to pay it back to factor. Non-recourse means no option available. Factor has to bear it from his own pocket. Factor cannot claim the amount from the client. This is already what we said. So now some of the functions and benefits mentioned here. Now functions means factoring helps you to have better assumptions about credit risk. You see, you may be a seller, but you don't know much about your debtor's profile. So factoring team will be analyzing the clients one by one and will be giving you very precise information about the quality of like asset. Maybe you see, they'll help you to have better assessment of your clients. Maintenance of sales ledger is what they do. Collection of receivables is what they do. Trade finance, sometimes when there is a need, they do it. And most of the time they do advisory services. Yani what are they doing is nothing, but they're doing it on behalf of the principal. They are acting as an agent, so they are advising it regularly. Okay, final call is to be taken by the seller. Credit analysis of customer. So these are the various functions of a factor. Now, what benefits do we have for a seller? Immediate cash flow. You will get money anytime. Invoice processing. So invoice will be processed very fast. Less costly means commission rate is very low. It depends on what percentage of recovery is there. No recovery, no commission. So it is directly proportional to amount of recovery. So if seller is getting 100% of recovery, means they are getting all their costs plus they are getting their margins too. So it is not a big cost for them to pay to factor. Okay, source of financing, uh, as in times of need you can ask it to them. Credit screening means they helps you in assessment, better assessment, and giving loan to only genuine parties, not to everyone. So you scan it, all your clients, and if some of them they are stuck, they are blocked, so you can remove them and can bring in a new set of clients rather than giving same clients for long tenures where value is kept outside. The cost of factoring on an average it is quoted somewhere between 2 to 5%. This is over prime rate of interest plus service charges. Again, you see it varies between 0.1 to 2%. So it depends the area where you are operating, the type of client you are dealing with. If they are stuck, if they are very rigid, if they are not recoverable in nature, so risk is high. So when risk is high, similarly, your commission is going to be high. Okay, but most of the time you see that they are dealing with people who are like readily available for repayment. They are good clients. Okay, next part of this presentation is forfeiting. Forfeiting is again the same process we did for factoring. The only difference is like, you see, now you're dealing with international party, so it is cross border transaction, international trade receivables are involved. And then here one more thing which you need to take is like, this is always without recourse, means factor is going to take the entire amount of risk. Forfeiting means the person who is going to discount, he has to take the entire amount of loss. Seller will be getting rid of his total loss. So the amount of risk involved in a contract will decide the discount rate. Okay, what concession will be the factor going to get on this sale? So it involves purchasing of exporter's receivable. Forfeiter will pay you the cash to the exporter. Importer is obliged to pay to the forfeiter. You see the same process. What factoring is domestic credit sale transaction, forfeiting is an international transaction. You can see this. There is an exporter. Again, you see, you do have, you see here, first is like, there must be a bank. Okay, then you do have a exporter and forfeiter. They are connected to each other. Then there has to be someone called as importer. Okay, so here one problem is there. This point is like, where importer must be there is not quoted. So importer is supposed to have like directly dealing with forfeiter. So whenever there is a call, you have to do it. Now you see, forfeiter means here you have some couple of points to be in your mind. Hold till maturity means on maturity date someone has to hold it up. So forfeiter will be holding it up till maturity, and on maturity date, this forfeiter will be getting the funds from the importer. Okay, so then sell to group of investors. Now point is like, here you see, most of the time what happens is like, exporter is comfortable, he is getting like lots of accounts. Some of the accounts which they are not comfortable with, they can sell the entire group portfolio to forfeiter. Okay, so this is one way of taking an exit. Trade in secondary market. So you do have a secondary market. When you sold your goods to some importer, so this is one to one primary. Okay, but now when you don't want them to deal with them for longer time, so there is a secondary market available. Forfeiter is providing you the secondary market, and you can sell and take an exit any minute you want. Now there is this slide shows you the difference between factoring and forfeiting. Now factoring is like we already discussed. It is within the territory and converting receivables into cash, whereas forfeiting is like purchasing of the claims in case of a export. Export means outside country. Okay, maturity of receivable, usually factoring will have a shorter period, whereas forfeiting, because it is an international transaction, so the tenure may be slightly longer. Okay, so it is mentioned here medium to long term, whereas in factoring it is short term. Now goods, so usually it is ordinary goods, any goods can be covered under factoring, but when it is forfeiting, you see, mainly it is capital goods. You are bringing in technology, you are bringing in heavy machinery, so for which we need to bring import these things from outside, or like you are exporting it to some foreign country. So there, you see, this is a specific type of requirement, hence we are going out overseas. Now, financing, you see, when it is local, we have to keep some NPA provisioning. We need to keep a margin, and we will not be giving 100%. But when it is international, where you see lots of standards are in place, you cannot cheat, because once you cheat, you will be blacklisted in market. So heavy risk if you do some error. So you see here, hence we can always rely, and this is some sort of privilege actually. So when you're doing international transaction, you can be getting 100% of finance. Then in factoring, you can have recourse and non-recourse both, but in forfeiting, you see it is only non-recourse. Who is going to bear the cost of this factoring? It is, you see, it is to be borne by seller in case of factoring, but in case of forfeiting, it is actually the buyer who has to do it. So seller will be transferring this cost to the buyer. So this is the additional cost for buyer to manage. In India, you see, if you do it, it is not the buyer who has to pay it. It is the seller who is going to pay you from his margin, his or her margin. Negotiable instrument? No, they are not negotiable in case of forfeiting. You see, when it is forfeiting, there you see, it is an international document, and it has an element of negotiability into it. Secondary market for factoring, no, you don't have. But forfeiting is an international phenomenon, so you see, you have a better secondary market here. So you'll find lots of buyers, or you see, who are actually giving you your secondary market scope. So this is what about we saw about the risk management process. We saw the concept and then the differentiation. Hope you understood this. Thank you. Good.